Hi, I wanted to go over an example of a cash flow, basically a cash flow statement, focusing specifically on the operating activities. So what we're focusing on, let me get a nice bright color here. Focusing on this, cash flows from operating activities. This is an example homework, one that happens to be number 7. I'm less concerned about the actual numbers, and what I want to do is want to take you through uh, the actual dynamics of solving this problem. When you get one of these on the test, and it talks about cash flows from operating activities, this is the type of data table you'll receive, so you need to know how to handle it. You will notice that in some ways the most important thing when you're doing a problem like this is knowing what to ignore, not knowing necessarily what to use. If you remember back from the slide deck, let's see if I can call it up here. Yeah, the slide deck here gives you a pretty good example of what it is you do when you're trying to create a cash flow statement, a statement of cash flows focusing on operating activities. You also notice that a statement of cash flows has not only operating activities, but also has investing activities and financing activities. But right now, let's just focus right here because that's what the problem is, operating activities. You will also note that I put this here for you. So you have an announcement that shows what to do with these different components. This is the top of this up here. Okay? So use this. Don't just ignore it. Notice that I have here for you for the operating activities portion of a cash flow statement. Depreciation is very easy. You always add it back. Let's drop down here to the bottom. Any kind of current liabilities. Remember, a liability is like a payable. An accounts payable would be an example of a current liability, not a long-term notes payable. Not, we're talking about anything that is due within 1 year. Any kind of increases, if they go up from 1 year to the next, you just add it. Add it. If it goes up, you add it. If it goes down, you subtract it. Notice these are normal. This is what you would expect, that if it goes up, you add it to the cash flow statement. If it goes down, you subtract it. Here's the weird ones in the middle. This is what we were joking around with in class about the cat. Notice that that if there's a loss, you add it. If there's a gain, you subtract it. Notice the exact opposite. If it's a plus, if it goes up, you subtract it. If it goes down, you add it. If it goes up, if you have a loss, a drop in current assets other than cash, you subtract it. You add it, and if it goes up, you subtract it. Very unusual. Just like I said, know that's the relationship between these. Another thing I want you to focus on, this is one of the reasons I have highlighting here. Notice everything on here, you have depreciation, right? So depreciation's easy, you always add it back. But I want you to notice everything in up and down this list of pluses and minuses, depending on what happens. Every single thing is a current asset, except for these two. Okay, so if you have a loss on the sale of a long-term asset, you add it back. Notice loss plus, opposite here, you loss plus. If you have a gain, you subtract it. So you have a gain, you subtract it. This is the only one that has anything to do with long-term assets, and it's for losses and gains on the sale of long-term assets and sale of long-term assets. Everything else is current assets or current liabilities. Hold this in mind because this will help you when you're working with these problems. The fact that everything's current assets, of course you always add depreciation back. Everything's current assets or current liabilities, current, except for loss or gain or sale of long-term assets. All right, so now we can look at this and start knowing what to do with it. Let's take again, get our color here. Notice immediately we see net income. That's easy. Net income gets put up here at the top. We always start a cash flow statement with net income. Then we have collection of dividend revenue. Well, I mean, collection, what does that have to do with operating, right? And not only that, where is this to be found here? Where are we talking about dividend revenue? Current assets, current liabilities, none of this is dividends. None of this is dividends, collecting dividends. And none of this is depreciation. This is simply, money that's collected. Keep in mind that these are non-cash items, right? This is not talking about cash. So this simple collection has nothing to do with the cash flow statement. Payment of interest. Again, where is payment of interest? If you have interest and you owe it and you pay it, where is interest up and down here? Interest is an expense. Interest is not a long-term asset, and it's not a current asset or a current liability. It's an expense. This goes on the income statement. It has nothing to do with these categories. This is why I was stressing before. Everything's a current asset or a current liability except for this oddity of loss or gain on long-term asset. Let's look at sales revenue. Well, sales revenue is obviously cash that you collect, but this number is already in here, right? The $215,000 minus whatever expense is applied are already in the $11,000. And if you look here, where in the world is sales revenue? There's no place for sales revenue, so you don't pay attention to that. Let's go ahead and cross them out. Payment of interest, collection of dividend revenues. See, we're ignoring a lot of stuff. Loss on sale of land. Okay, well, land is a long-term asset, right? Land is a long-term asset. By the way, we always know we add back depreciation, so it's going right here. Okay, so we know what to do with that. That's the easiest one of all. Loss on sale of land. Well, land right here. Land is a long-term asset. You had a loss, so you add it back. And here it is being added back. We added this. We added this. Okay, now let's look at decrease in current asset other than cash. Well, let's back over here. I want to stay on the exact same pattern. I want to start messing around. I want to stay here on the pattern of looking through all these. Acquisition of land with cash. So you wanted cash, you wanted land, and you paid cash for it. Okay, this is a long-term asset. So this should kind of go, oop, long-term asset. Maybe I need to do something with it. Well, here's long-term asset, but this is loss on sale or gain on sale. Where in the world does it talk about loss or gain on sale of this land? It doesn't talk at all. This is just a simple acquisition. This has nothing to do with loss or gain or sale of this long-term asset. Nowhere on here does it say when you purchase a long-term asset. Okay, so again, you ignore this. Depreciation expense, we already handled that. Here's current liabilities. Remember we said current. When you see current, you need to pay attention because there's a good chance you're going to do something with it. So here you have an increase in current liabilities. This could be an increase in accounts payable, right? So on a different kind of problem, you might see that accounts payable have gone up, either by looking at last year versus this year, or it just tells you that accounts payables have gone up. Any kind of current liability. Well, let's look here at the current liabilities. Here's our current liabilities, and it says that we had an increase, so it went up. So an increase in current liabilities, you add back. Increases in current liabilities. Increases in current liabilities. Literally, it's telling you what to do. You add it back. So here you add it back. Oops, I'm putting it on the wrong line. So now we've handled this one. Decrease in current. When you see current, it's like electricity going through your body, right? Decrease in current assets other than cash. Well, here's current assets. Decrease in current assets other than cash. This is not talking about cash changing from one cycle to the next. It's talking about current assets other than cash. So here you literally have decrease in current assets other than cash. Decrease in current assets other than cash. That's $29,000. We come over here. If it decreases, right? If it decreases, you add it back. Decrease, you add it back. So here you have your add back. When you add all these together, the $11,000 net income, and this happened to be one where everything was an addition, you come up with $96,000. I wanted to just give you an idea of what was happening here. It says here about evaluating the cash flow. Well, operating cash flow is strong, as shown by the positive cash flow. You can see that the cash, net cash, has climbed quite a bit from 11,000. You started with net income of 11,000, but what really, then the amount of cash that actually went up is quite a bit more. So if you looked at just this number, right, and did not do the full analysis, you'd say, wow, they don't have that much cash. Well, net income's not tied to cash. GAAP separates net income from cash. So when you go through this analysis, then you see how much true cash they actually have. This type of problem when you're working through it on operating activities. The key thing is having this in mind, knowing that you always add back depreciation, knowing that anytime you see the word current, right, current assets, current liabilities, if it's a current asset that's going up or down, you got that weirdo deal, where it goes the opposite direction. If it goes up, you go down. If it goes down, you go up. If it's a current liability, if it's a payable, current liabilities act normally. Notice just these two act normally. Everything else acts weird. And then long-term assets, if you see a change in long-term assets, don't immediately don't immediately go, oh, long-term assets, I got to do something. It's only if there's a loss or a gain on the sale of that long-term asset. Otherwise, it has nothing to do with this. Look at this, and you can see, oh, well, I'll keep going here. Payment of dividends is no different than receipt of dividends. Where in the world does it say anything about dividends here? This has nothing to do with operating. And payment of income tax, the same way. I mean, where in the world are we talking about payment of income tax? Okay, this would just be reflected in the cash balance, the normal cash balance. These type of adjustments are not the normal up and down cash differences. These are the things that the ending cash balance need to get from net income to get to the ending cash balance. You need to adjust for these odd things that are not cash to get to what the cash flow is. So this leaves you with what is left over. In other words, this is everything else we've paid attention to. I hope this helps you. The biggest thing you can do with this is practice. The more you practice, the easier it is to remember what components are added and subtracted to get from net income to net cash provided by operating activities. I hope you found this useful.